Okay, let's try and unpack this. You always hear these quick takes on why currencies move, right? Interest rates go up, the dollar strengthens, or maybe an election causes jitters.
Yeah, the headlines give you snapshots.
Exactly. But what's really going on underneath? What are the fundamental forces driving these massive global money flows? That's what we want to dig into today.
It's crucial stuff. And you mentioned inflation first in the outline, which is a good starting point. Think of it maybe less like a price tag and more like
Hmm.
economic health.
Okay.
If inflation is consistently high, it just erodes what that currency can actually buy. It loses value.
Like things just cost more.
Exactly, both at home and when you compare internationally.
Mhm.
The extreme example everyone points to is Zimbabwe, where hyperinflation basically made the currency worthless. They were literally cutting zeros off
Right.
banknotes.
A total collapse.
Yeah. But for most stable economies, it's more subtle. It's really the difference in inflation rates between countries that matters over time. If one country's prices climb faster than another's, its currency tends to, well, weaken.
So that idea of purchasing power parity, where everything should cost the same after you convert currency, it's more theoretical.
It rarely lines up perfectly, no. What really gets money moving, often much faster, is the hunt for yield, interest rates.
Oh, okay. The magnet effect.
Precisely. Higher interest rates, they pull in capital from all over the world. Investors want the best returns, so if country A offers much higher rates than country B, money flows to A. That increases demand for country A's currency, pushing its value up.
And this is where that carry trade comes in.
Yes, exactly. It's fascinating. Imagine borrowing money in a currency with super low interest rates. Think the Japanese yen for years.
Near zero.
Right. You borrow yen cheaply, then you swap it for, say, US dollars, and invest it to earn those higher US interest rates. Multiply that by billions. It creates huge demand for the dollar and huge selling pressure on the yen.
But that also explains that weird thing with the yen, right? Sometimes it surges when there's a crisis, even though its rates are low.
That's the paradox. When global markets panic, those carry trades suddenly look way too risky. So what do investors do? They scramble to close their positions.
Meaning they have to buy back the yen they borrowed.
Exactly. All that sudden buying demand makes the yen spike. It becomes a sort of safe haven, but partly because people are unwinding these trades. And it's not just rates either. Think big investment trends like the US tech boom or AI now. That pulls in capital too, boosting the dollar because people need dollars to invest.
Okay, so rates and investment opportunities pull money in. What about the overall flow, like a country's entire financial interaction with the world? The balance sheet idea?
Yeah, the balance of payments. It's like a giant ledger tracking all the money coming in versus going out. Trade, investments, everything.
So imports, exports, foreign investment.
All of it. If a country consistently runs a surplus, meaning more money flows in than out, there's fundamentally more demand for its currency. It tends to strengthen. China is a classic case after joining the WTO. They had that double surplus, strong trade, and lots of foreign investment coming in. The renminbi appreciated steadily for years.
Makes sense. More demand, higher price. But what happens when things look shaky? How does risk play into this?
Oh, risk is a huge immediate factor. Political instability, economic crisis that can trigger massive capital flight. Money just leaves fast.
And the currency tanks.
Absolutely. Look at Venezuela's bolivar. It basically collapsed because of the internal chaos. But it doesn't even need to be a full-blown crisis. Just the perception of risk, uncertainty can cause sharp drops.
Like the British pound after the Brexit vote?
Perfect example. Or doing some of the recent political turmoil there. Markets hate uncertainty, and that gets reflected in the currency fast.
So putting it all together, Turkey's lira seems like a real-world stress test of all these forces colliding, doesn't it?
It really does. You had initial problems like high inflation and trade deficits pushing the lira down, but then things got unusual.
The interest rate policy.
Right. The previous leadership pushed the central bank to cut rates, even as inflation was soaring. That was based on a very unconventional view, and it just poured fuel on the fire. Hyperinflation took off, and the lira's collapse accelerated.
Then they reversed course dramatically, right?
Yeah.
Huge rate hikes, the standard medicine.
They did. But interestingly, even after those massive hikes started, the lira still plunged initially.
How does that work? Shouldn't higher rates help?
Normally, yes, but here's the thing. For a while, there had been various controls kind of holding the exchange rate artificially high. When the new team came in and signaled a return to more orthodox policy, those controls were loosened. The lira then fell sharply to find its sort of true lower market level that reflected all the built-up pressure.
So it was like suppressed value being released.
Exactly. It really shows how much market trust matters. Once that's damaged, even textbook policy moves might not work immediately, or can have unexpected short-term effects as the market finds its footing again.
It's quite a story. And, looking back over the last 50 years or so, the U.S. dollar seems to have experienced almost all these pressures at different times.
Definitely. You had the risk after Bretton Woods collapsed, the high inflation, then Volcker hiking rates sky high to combat it.
The dot-com boom, pulling in investment.
Global financial crises causing safe haven flows. It really illustrates how all these factors, inflation, rates, capital flows, the overall balance, and risk perception, are constantly interacting in complex ways. It's not always predictable which one will dominate at any given moment.
It feels less like predicting a single number and more like understanding these deep, powerful currents.
That's a good way to put it. And it leaves you wondering, doesn't it? With all this constant change, all these powerful economic forces pushing and pulling, what is it that really anchors a currency's value in the long, long run? Beyond the day-to-day noise, what gives it enduring stability? Is it just the economic numbers, or is there something more fundamental, like global trust,